Hi guys, and welcome back to the Simplify LLC channel. In this video, we're going to deep dive into how to pay yourself with an LLC. I think I got your attention. Please make sure you hit that like button and press that bell icon to subscribe so that you can be notified when we push out more LLC content like this one. All right, here we go. If you recently became the owner of a limited liability company, congratulations. There's so much you can do with an LLC, but have you considered the tax implications of paying yourself from your company? You have at least three options, which are an owner's draw, guaranteed payments, or an employee wage. Each choice can depend on cash flow, member shares, how many employees you have, or whether you are reporting as a sole proprietor, partnership, or some type of corporation. Some of this should have already been decided when you formed the LLC and got assigned a classification for how to report profits and pay taxes. Basic single-member LLCs cannot pay the sole member a salary because the LLC is a disregarded entity under default tax classifications. Now, instead, you should take an owner's draw from the profits. These payments can be fixed monthly amounts or a lump yearly sum. Either way, you'll report all your company's profits and losses on your personal income tax return, not just what you take. 20 to 30% of company profits tends to be a safe owner's draw, though this might be lower if you have employees or want to reduce your tax bill. If your LLC hasn't made a profit, you can still take some of the company money and end up with negative equity in the business to resolve later. Always remember to keep documentation proving your transactions. With an owner's draw, you might want to write a check from the LLC's business account and deposit that into your personal account in case of an audit. This helps to show separation between you and your LLC. If legal action is ever brought against your business, a lack of separation between business and personal funds could void the LLC protection. Multi-member LLCs have each member report their individual share in addition to their personal taxes, and then get taxed as a partnership. Make sure your LLC has an operating agreement which describes how profits, losses, and distributions are made to avoid future disputes. Members cannot be considered employees or receive a salary, so they take distributions, owner's draws, or guaranteed payments. Partners pay self-employment and income taxes based on their distributions. Owner's draw payments are not recorded as a business expense for bookkeeping and tax purposes. They're instead marked as distributions of profit on the balance sheet. Members receive individual forms at tax time detailing their share of the profits and losses for their personal income tax returns, and again, must pay taxes based on the total amount from the partnership. Another option here is guaranteed payments, which are issued no matter how much profit the company makes. This can result in negative equity and isn't recommended for companies unsure of profit. When an LLC member also manages the company, they're entitled to management compensation plus the normal ownership distribution. Non-member managers are considered employees and paid whatever is reasonable while withholding payroll taxes as needed. One can organize an LLC to be taxed as an S Corp or C Corp for tax purposes only. Keep in mind that you'll still keep the personal liability protection that comes with an LLC. Single and multi-member LLCs with S Corp status can make members employees and give them a salary, then pay payroll taxes instead of self-employment taxes. They can save on their taxes because employee wages are an operating expense and a deduction, the same as supplies and legal fees. As a W-2 employee, they can schedule their salary at fixed intervals and automatically withhold federal and state tax payments from their earnings. Keep in mind that members can still take owner's draws even if they're getting a salary. Choosing to become a C Corp means the owners become shareholders who can then receive compensation. They can keep earnings in the business or distribute profits as dividends. The IRS taxes the earnings of C Corp members once at the corporate rate and then again at the shareholder's personal tax rate. C Corp LLCs file corporate tax returns with a separate tax return, Form 1120, in addition to the shareholder's individual tax return. S corporations file using Form 1120S to report their business activity, which is then transferred to each member's K-1 personal tax returns. The salary and non-dividend distributions of an S corp are not subject to corporate income taxes when you are not paying yourself dividends. Even if the LLC has no income or activity, they must still file the necessary tax returns. So, what is the best way to pay yourself as a small business LLC owner? Well, that depends on the size and structure of your business. Single member LLCs might prefer owner draws, while partnerships might also try guaranteed payments. Special corporate statuses might choose salaries, dividends, or profit distributions. Remember to keep business and personal funds separate so your LLC can continue to provide the personal liability protection you wanted. Well, that's all the time we have for today. Thanks very much for watching. To find out more about LLCs and other business information, check our link in the description below. And remember, sharing is caring. Please like and subscribe. Also, we would love to read your comments and answer any questions you may have. Thanks again, and we will see you next time.